the 10-year nominal Treasury yield is roughly the same level as the Fed funds rate. And rarely in the history is this dynamic sustained. So just look at the dark blue line and the red line in this chart, dark blue line being the Fed funds rate. The red line is the 10-year nominal Treasury yield. I'm just going to draw a line over the 10-year nominal Treasury yield. Stare at the blue line while I'm doing this. You see how the yellow line that I'm drawing is rarely at the same level of the blue line, rarely at the same level of the blue line, rarely. Very rarely is the 10-year nominal Treasury yield at the same level as the Fed funds rate. So what does this mean? Historically, the 10-year is roughly on a median basis 120 basis points wider than the Fed funds rate. So the current, basically flat spread, 8 basis point spread, implies that 10 years should either be greater than 5%, or I hypothesize, based on the U-shaped economy, that the Fed funds rate should be 3%. So one of these markets is wrong based on the historical relationship between the Fed funds rate and the 10-year nominal Treasury yield. So I'm betting that the market is better at setting rates than the cabal of people, human beings, this 12-person body of human beings determining the price of money and quantity of money for the world economy. I'm guessing that the global financial markets are better at pricing those things than this cabal of human beings. Very flawed human beings in many respects in terms of their inability to set credible, thoughtful, sound monetary policy. So in our view, the Fed funds rate should already be at 3% based on the spread, the historical spread. If the Fed funds rate is at 3%, then we would have a normal level of spread between the 10-year and the Fed funds rate. So I'm betting on the market here. Historically, the 2-year is about 30 basis points wider than the Fed funds rate. The current spread of minus 43 basis points implies the 2-year should either be much higher at 4.25%, or I hypothesize, because the market might be better at setting the price and quantity of money than this cabal of unelected people, the Fed funds rate should be somewhere around 3.25. I don't care if it's 3 or 3.25. The market is telling you, Mr. Powell, that the policy rate should be 3 or 3.25. Listen to the market. The market should be the one setting the price of money for the economy. Don't let this cabal of human beings do it. And maybe that's what Treasury Secretary Scott Bessent was signaling. They got to overhaul this institution. I wouldn't make it more market friendly. That's what Wayne Angel and what was the other guy? Manley Johnson and Wayne Angel back in the 90s. They were basically saying, hey, if we just target the price of the dollar and try to stabilize the value of the dollar, we wouldn't have to do all this ridiculous stuff with regards to monetary policy. Maybe they should revisit that. I don't know. I'm not smart enough to fix the Fed by myself. Nobody is. The point I'm making is that, this cabal of unelected econ PhDs that think they know how to run the world, that obviously have a horrible track record at, creating all these negative outcomes in the economy and financial markets and ruining people's lives along the way. Maybe they should take a step aside and let, us market people try to figure it out, or have more thoughtful discussions about, how to fix them, fix this stuff. Because I tell you right now, if they think what they're doing is working, then boy, oh boy, you would never allow this level of unaccountability in your private sector organization. If you run a business, you would never allow this, consistency of failure and this lack of accountability to persist for as long as we, the American public, have allowed it to persist in financial markets. And so I rest my case on that. Let's keep moving. In our data-driven view, i.e. the U-shaped economy is a contraction in the labor market, U.S. dollar money markets are correct to price in roughly 4 more rate cuts over the next 12 months, and 3% is neutral. So if you go back to this slide here, you see that the market, if you look at the overnight index swap derived floor Fed funds rate, so the minimum value on the YS curve out 5 years is 3%. And that's where the OS market is currently signaling we're going to get to over the next 12 months. So the market is, in our view, we think the market is correct. There's obviously a pretty significant, slowdown in the economy going on, as evidenced by the Beige Book. I want to say roughly 48, if you did it on a GDP weighted basis in terms of the regional bank, the 12 regional banks, roughly about 40 to 45% of the economy signaled declining activity in the most recent Beige Book. So that was kind of peculiar in the context of, this data vacuum that we've been in, that Powell got incrementally hawkish in this read. Like the biggest data point that they've gotten in the last month and a half has been the Beige Book. And the Beige Book was incrementally worse from the perspective of the labor market. And obviously we got better news than expected on the inflation front 2 Fridays ago. So I don't know. I don't understand this ridiculous data dependency. It's not working. It's just not working. But I understand why they're doing it. It's a CYA exercise. Google that if you need to. It's a CYA exercise because they overdid it in 2020 and 2021. So they're underdoing it now as a result. And in my opinion, you need to just do it right. How about we don't overdo it in 2020 and 21 and don't underdo it in 2025? How about we just run sound, thoughtful, credible monetary policy? That is an option, by the way. The econ PhDs will tell you that that's not an option, but I'm telling you right now, you can just do it correctly. So think about that. More than 2 rate hikes have been priced into the real floor Fed funds rate since late August. This increases pressure upon the administration to replace Powell with a credible candidate if it desires structural regime change at the Fed, which is a necessary outcome given that the administration has chosen to delever the public sector balance sheet via growth, i.e. paradigm C. So the reason the Fed needs to support fiscal dominance is because the administration, which was voted on into office by the American public, unlike the unelected, unaccountable, econ PhDs at the Federal Reserve, the American public said we want growth. We want to fix the problems, our K-shaped society with growth. And so administration has obviously pivoted from paradigm B, which I personally think is the better outcome. Cutting is more painful in the near term, but it creates the conditions for a durable expansion of real median wage growth, which is the real nirvana of what we're trying to achieve here. That will, cutting the size of the federal government and ultimately freeing up all that capital would be much better for the economy over the long term. But again, people didn't want it, as evidenced by the Congress passing the one big ugly bill. You saw what happened in the Biden administration. It's not politically popular to cut, the way Elon Musk signaled that they were going to cut last fall with the stupid chainsaw thing. And so obviously Doge was a failure. In fact, it was a bigger failure. I said this a couple weeks ago, but to me, the reason gold is up so much this year is because the failure of Doge signaled there is no will at all, either from this side of the aisle, that side of the aisle, this unelected bureaucrat, that unelected bureaucrat. Like, well, there's no way we couldn't even Doge our way out of this problem. And so that's what gold is signaling, is like there is no hope for paradigm B to be durable and sustainable. And so ultimately now we have to go into the growth phase, and then followed by the growth phase. What will follow the growth phase at some point in several years from now, most likely, is the print phase. But as long as we're in the growth phase, the Federal Reserve has to get on board. You cannot sit here and fight it, because you know what's going to happen if you keep fighting it. More of the same. If the Fed continues to fight it, we're just going to have more of the same with this part of the K-shaped economy. These guys booming, having a ball, flying first class from Aspen to Montauk and back again. And this part of the K-shaped economy, as evidenced by what Chipotle told you this week, trading down at the lunch line, trading down at the grocery store, falling behind on rent payments, falling behind on medical bills, falling behind on health insurance premiums, falling behind on car loans. This is not an acceptable outcome. It's not. Zohran Mamdani, who's probably going to be the mayor of New York City, the alleged global hub of capitalism, on Wednesday morning, is going to get elected because of this. If you don't understand, if you don't follow the bouncing ball, where will our country be 3 to 4 to 5, 6 years from now if the Fed continues to stand in the way of growth? Jay, you can't do it unless, of course, you want this whole entire country to be run by socialists. And maybe that's the agenda. So getting back into this chart here. So I drew too much on the chart here. So what I'm trying to say is, if you look at the real floor Fed funds rate, that number has gone up by almost, let's call it 50 basis points since August. And it's all been basically driven by the decline in the 2-year inflation swap rate. It's not necessarily being driven by sharp increase in the floor Fed funds rate. But, the fact that you're having this sharp decrease in the 2-year inflation swap rate, it tells you that monetary conditions are tightening, and the consensus was, too aggressive with regards to their inflation pricing as a function of tariffs. Either way, we're moving in the wrong direction. You're not going to boom the economy with a positive, real short rate. You're just not. You're not going to. We're not going to get anywhere in terms of, ameliorating the impact, the crowding out that we continue to see from the explosive growth in the public sector balance sheet as a function of this kind of fiscal largesse that both parties are contributing to and refuse to meaningfully address. So this number has to go way lower. And ultimately, we think the next Fed chair understands everything that I've been talking about for the last 10 minutes and will take steps to remedy that. They're going to get a fight from people who don't, the folks on the Federal Reserve Board who don't understand what I've been talking about for the last 10 minutes, because obviously if they did, we would have been having a conversation right now. We would already be where we need to be to boom the economy to address decay. So we'll see. Transition to the balance sheet. Regarding the Fed's balance sheet, the FOMC did a good thing by signaling a near-term end to the balance sheet runoff on December 1st. And the reason I say that is because the policy, when you factor in the balance sheet, this chart here shows the Fed funds rate in the blue line, 5-year Z-score of that, the Fed balance sheet, the GDP in the red line, the 5-year Z-score of that on an inverted basis. And then the mean of that is the black line. You see the Fed's policy was extremely tight when you factored in the balance sheet. Obviously, it's basically back to neutral when you look at it just on a policy rate basis. But the balance sheet was very tight. If you add a few more indicators, so we call that the Zervos indicator over there, the mean of those two statistics. If you add a couple more statistics, so the Fed balance sheet divided by total U.S. financial assets outstanding, the 5-year Z-score of that, Fed sum portfolio divided by marketable Treasury debt plus total residential mortgage debt outstanding, the 5-year Z-score of that, you get about a Fed policy aggregated Fed policy setting that's significantly tighter than the policy rate. So, this was causing problems. As we've highlighted in recent weeks, conditions in funding markets were quite stressed and warranted immediate attention. So the chart here on the right shows the tri-party general collateral award rate minus the interest on reserve balances. So the spread between those two levels is an indication of secured funding conditions. So whenever you have a positive spread, i.e. the TGCR is above IOER, that means there's scarce liquidity, because typically it tends to be lower than IOER, because the Fed is trying to operate with this ample reserve regime framework. And so if there's not ample reserves, then you're going to have TGCR above IOER. And so if you look at that statistic on a trailing 5-year basis, the most recent 3-week moving average was in the 99th percentile, and it was a 4.1 sigma relative to the trailing 5-year mean. Very tight conditions, secured funding conditions in the repo market. If you look at the secured overnight financing rate minus the effective Fed funds rate, and so the spread between that just shows the general funding conditions. So whenever you have a spike in that or significantly positive value in this statistic, it indicates there's a collateral shortage. You can't find the collateral to secure your overnight financing. And so the latest 3-week moving average of that was in the 99th percentile and is a 3.7 sigma relative to the 5-year mean. So this is a very stressed out conditions in the repo market that we highlighted a few weeks ago. And so we're giving a golf clap to the Fed here for recognizing that. We had a sharp decline in bank reserves, and it was causing problems in the repo market, and it prompted a rare on-time response by the file Fed. I mean, this has been, the president is lambasting him for being too late for a reason, because his entire career as Federal Reserve Chair has just been a series of, responding to very obvious economic and financial market signals late. I mean, granted, the Federal Reserve as an institution is kind of designed to be, late, but not as late as Powell. The more late they're never going to be, they're rarely on time. This was a very rare indication of them being on time. And so I do want to give them credit for that, because obviously this is a step in the right direction. But again, the Fed, the Federal Reserve is I sound like I'm being overly critical. I'm not trying to be. I'm just being honest about what I'm observing in our research. This is a really difficult job. I don't want to be the Fed chair right now in the middle of a fourth turning. You kidding me? You basically have to choose between blowing up the bond market on a real basis or blowing up the bottom of the K-shaped economy. Yeah, I just, what I mean? Like that's a difficult choice to make. And I wouldn't wish that choice to my worst enemy. But, so I'm not saying that they have an easy job here, but I'm telling you right now that if you have if you study economic history, the choice that society always has historically made is inflate. For whatever reason, when you stick the banana to our head as human beings, we think the illusion of growth via inflation is better than the contraction of depression, the contraction of recession. We don't like deflation. We don't like going backwards. Human beings, we all are, mortal. So time matters for us. So when we have to go backwards, it's really painful. Obviously, inflation is painful as well, but it's for whatever reason you study all these historical episodes. When you get to these problems in society, inequality and the like, people tend to inflate. And so I'm not saying this is a great outcome. The better outcome, again, would be to significantly reduce the size of the federal government and allow that capital to return to the private sector. And obviously, you would have to go through a recession to do that. But again, a recession would allow you to reset the economy from a lower comparative base that allow for a real durable expansion of real median income. particularly if you pair that with some positive regulatory changes in terms of bank regulations, et cetera. That's the real formula for fixing this. But obviously, human beings go to the ballot box and they don't vote on that. They vote for boom the economy, and they voted for boom the economy as evidenced by the historic share of counties that the current president won last November. So the Federal Reserve, get out of the way of the will of the people, period. So so the chart on the left is the reserve balances with Federal Reserve banks divided by commercial bank assets ratio. So that is minus 2.7 sigma on a trailing 3-year basis in the 1 percentile. So obviously that was causing some significant problems in the repo market. And again, golf clap, hat tip to the Powell Fed for finally, propagating a rare on-time response to a meaningful signal in the economy and asset markets. First time in 7 years now. The Fed's summer portfolio as a ratio of total marketable Treasury debt and total U.S. residential mortgage debt has declined by roughly 10 percentage points from its February 22nd peak to 15%. So again, if you look at so this is the blue line here, that's what I'm referring to. We're now at 14%. We peaked at 24%. I don't know what the right number is, but I know it's not 14%, as evidenced by the problems we saw in the repo market and the increasing size of the bottom of the K. Again, it's not even the increasing size of the bottom of the K. What's happening? So the K-shaped economy started off looking like this, and now where where on the y-axis the bottom of the K intercepts, it keeps getting higher. Like the more and more people are falling down on the bottom of the K, as evidenced by all the earnings calls we continue to hear from the consumer sector. I mean, basically, if you're not part of the AI boom, or you're not getting handed big checks from the government like Elon Musk and Alex Harp or Don Eric Jr., you're pretty much, SOL. And that's not an acceptable outcome for society. So I'm telling you right now, it's like, again, I'm just using math to anticipate policy intervention. And the highest probability policy intervention that we see that is currently underpriced in financial markets is monetary policy intervention. We think the markets pretty much understand the deregulation agenda. We think the markets understand the fiscal easing from the one big ugly bill. We think the markets understand that trade policy was never going to be as bad as consensus thought it was when we told you it wasn't going to be as bad as they thought it was back in the spring. And so now the thing that we see is most mispriced relative to our paradigm C theme is the Fed. So that's why we're focusing on it so much. And so it's about understanding the incentives and understanding, what has to happen as opposed to what other people think must happen. This stuff has to happen. It's going to happen. So it's just about timing it, in our opinion. The Fed has allowed 1.6 trillion of Treasury securities to roll off its balance sheet since its holdings peaked in May of 2022. That was 1 month ahead of the peak in headline CPI at 9.1% year over year. I mean, these guys, when the other party was in office, they were doing QE up until inflation was almost 10%. And now they're hawks. I literally don't even have anything to follow that up with. My brain emptied. I have nothing to say about that. It is absurd. I'm guessing that inflation was somewhere with an 8 handle on when they were doing QE in May of 2022. But now inflation it's 3% even. And they're telling you that they can't get you another rate cut in December. Like, I don't understand this Fed at all. I mean, you tell me if they're politicized or not. The Fed guiding the market to increase use of the securities lending facility and standing repo facility represent a step in the positive direction in terms of addressing the K-shaped economy crisis. Now that the administration has pivoted from paradigm B, which is the cut phase, which is what we really need and probably won't ever get until there's a significant crisis, to paradigm C, which is what they've chosen and what the American public has chosen, is grow. So we talked about how the SLF essentially will allow the Fed to warehouse bills on its balance sheet, but obviously lend them back out, at high quantities. So essentially, this is, the issue with the Treasury issuing a lot of bills is great. It's great because bills are the most pristine form of collateral in the repo market. But a lot of times when there's ever any stress or concern or nervousness in the financial sector, the repo market starts to get very fragmented because people start hoarding cash and hoarding bills. And that's not good. So what the Fed is essentially trying to do is say, hey, let me hoard them all because I'm happy to lend them out to anybody. And so that's exactly what's happening here with the securities lending facility. And then obviously the standing repo facility is a self form of debt monetization. If people who buy coupon debt from the Treasury, which is pretty much all of us, private non-bank sector, commercial bank sector, foreign sector, foreign official sector. Just anyone who buys treasuries, or at least the dealers now, at least have access to this facility. They can now swap their coupons. They can liquefy their coupons for cash. And so what it ultimately means is that they no longer have to hoard cash or bills at any point in time, because they know they can always get cash with the coupons they have. And it's liquid. It's definitely a step in the right direction, because what it's doing is it's going to reduce the cost and increase the quantity of credit available for the real economy via the repo market. Again, these facilities aren't huge, but over time, they're going to, in our view, they think they're going to get huge if we continue to see a further shift, a further the acceleration of the dovish net financing policy that my fellow Yale, Scott Bessent, has inherited from our fellow Yale, Janet Yellen. We think we're going to see a lot more of that over the medium term, as in line with what we outlined in our recent macro scouting reports. There's just a wall of money coming in terms of the stable coin issuance that we're likely to see. So if they want to be financially repressed, go financially repress them. The Fed's failure to acknowledge structurally higher inflation was not the only reason we've long called for regime change at the institution. Its failure to acknowledge fiscal dominance is also a key factor. So again, if you have the Treasury is issuing $11 trillion, up from what $3, $4, $5 trillion, it's not, in terms of in terms of the marketable Treasury debt maturing, the annualized budget deficit, and the divestment from the Fed Soma portfolio. It's not about the nominal number. It's about how much global savings are you gobbling up. 36%, not quite double what we used to be, but still significantly higher. And so the gap between these two numbers represents money that is not going to the housing market. It's money that's not going to small businesses. It's money that's not going to low to medium income consumers. So there's a vacuum here of money that used to go to those sectors, the economy, and it doesn't exist. It's going to Uncle Sam. So the Fed has to figure out how to make money cheaper and more available. And the Fed hasn't been doing that. And that's why, one of the many reasons why we have this growing K-shaped economy. The dramatic increase in the quantity and cost of federal borrowing is contributing to the historic crowding out of consumers and businesses on the bottom of the K. So as I mentioned, we got $11 trillion of marketable Treasury debt supply over the next 12 months, but another incremental $59 billion in interest payments. And again, if you look at that statistic, this $11 trillion statistic, it's 209% of U.S. Savings. In terms of, it's 20% of U.S. savings, obviously, which come from the private sector, household, and corporate sector. That's almost double what it used to be. So again, as I mentioned, the gap between these two numbers, the long run mean and the current value, represents money that is not going to the housing market. It's money that's not going to small businesses. It's money that's not going to low to medium income consumers. So there's only enough money left to go to capitalize the AI infrastructure bill. There's only enough money left to go to Elon Musk and Alex Karp and Don and Eric Jr., or Eric and Don Jr. So this is why, again, this is part of the reason. So I'll end on this. The frozen housing market is a classic example of the Fed's too tight monetary policy, crowding out businesses, household, and sectors of the real, not digital economy. So if you look at this spread, 286 basis points, spread between the marginal mortgage rate of around 6.5% and the effective mortgage rate just north of 4%. So, the spread is essentially creating this lock-in effect. And the reason the spread is so wide is because there's not enough money beating it down. There needs to be money beating the red line down. If there's no money to beat the red line down, then the spread's going to be high. And so as long as that spread's high, then the people who have the 4% mortgages aren't going to move, because they're going to have to, their mortgage payment's going to increase by 200-300 basis points. And the people who don't have a house yet, but want a house yet, can't afford it because the marginal mortgage rate is too high. It's a double whammy. And so this is why the existing home sales market has been structurally depressed for 3 years now. We've been tracking at financial crisis type lows in existing home sales for the last 3 years without a financial crisis. This is it. So this is just one classic example of crowding out. Crowding out. And again, it's not the Fed's fault that the government is too big. It's not. I'm not blaming the Fed for the fiscal policy. But what I am doing is blaming the Fed for not responding to fiscal policy dynamics. Fiscal dominance demands substantial monetary debasement and financial repression. If you don't have monetary debasement and financial repression, then you're going to get a crowding out, period. And the crowding out equals the bottom of the K getting bigger and bigger and bigger. And so it seems like the administration is on it. And in our opinion, that's a positive for society, and it's a positive for asset markets. So we'll wrap it up there. Darius Dale here, presenting our Around the Horn for Saturday, November 1st, 2025. Best of luck out there. We'll catch you back here next week. Cheers.